Hello CFA candidates. Welcome to this segment on the pricing and valuation of currency swaps. Hope this video could help you to save time and energy. Let us begin. One of the main aims of a currency swap is often to get hold of the other currency. I don't have access to the markets in your country, so I want you to go to get it and give it to me. So you raise that amount. I borrow it from you and I swap some currency back to you that you may need. So I actually want to get the other currency, hence we actually swap the principals at time zero. With a plain vanilla swap, we work out the fixed payment. We compare it to the floating and only the net payment would be made. But, we can't net these payments off in a currency swap because they are in different currencies. So we'll work out the fixed payment in one and the fixed payment in the other. What are we looking at? We have to work out interest rates here to price currency swaps. We have two currencies with different term structures behind them and we are going to swap a fixed rate in one currency for a fixed rate in another currency. That's all. We're just worried about calculating the fixed rate in one being swapped for a fixed rate in another. Now, do we already know how to work out the fixed rate in a swap? We do, we just use the term structure and that discount form factor formula. We'll just need to do that for each currency. Now let's put one into practice. Assume the fixed rate on a 1-year quarterly, $1 million interest rate swap is 4.4%. And we've got a comparable set of UK rates for 90, 180, 270 and 360 days. As always, quoted as annual at 360 day. Turn them into discount factors. Then, we take 1 minus the final discount factor and we divide that by the sum of the discount factors. So the fixed rate on a 1-year GBP interest rate swap will be if it settles quarterly. 1 minus the final discount factor over the sum of all discount factors. That would give you the quarterly swap rate. We always quote the rates annually, so if it's a quarterly swap multiplied by 4. And you get the UK fixed swap rate stated on an annual basis as 6.8%. Okay, so we have our USD and we have our GBP in terms of pricing currency swaps. Next, let's play with the principals. We're calling them notional principals. They are actually swapped. So in order to work out the notional principals, and we told the current exchange rate is 0.5. That means you get 0.5 of a GBP for every US dollar. Well, first up here was your USD notional principal. We were told it was a 1 million US dollars. If the spot rate is 0.5, then we're gonna multiply by that exchange rate, 0.5. 1 million US dollars equates to 0.5 million pounds sterling. So we have the US notional principal of 1 million and a GBP notional principal of 0.5. Now we have all the tools we need. We have the notional principals. And we have the fixed rates. Put those two together and we'll be able to calculate the payments. So our quarterly GBP fixed payment. We know the notional principal. It's 0.5 million. We know that GBP fixed rate. We calculated it as 6.8% as always in swaps. That's an annual 360-day simple quote. So to turn it into a quarterly payment, we must multiply it by 9360. Multiply it by the notional principal that tells us every quarter. We'll be paying 8,480 gigabits per second. USD same exact method. We were told to assume fixed rate on the USD was 4.4%. It's quarterly, so multiply it by 9360. On the notional principal US dollars was 1 million. Multiply that out. We have 11,000 US dollars there. All your flows, they cannot be netted off. They're in different currencies, so we will be paying 42,500 and receiving 55,000 US dollars. Or vice versa every settlement date. And in addition, the notional principals will also be exchanged. So we can look at all of those flows together. What happens at T0? Well, at T0, 1 million GBP goes from party A to B and in return we receive 1 million US dollars. Currencies are actually swapped physically. Then every settlement date 90, 180, 270 and 360. Also, it'll be a final payment along with the notional at 360. We got those payments that we just calculated 8,480 gigabits per second and 11,000 US dollars. And then finally, the notional principals are swapped back. Let us continue with the same example of quarterly swap of USD and GBP. After 300 days. The rates for USD and GBP are 5.4% and 6.5% respectively. And the exchange rate now is 0.55. We need to calculate the value of quarterly swap for USD fixed receiver. So, after 300 days, we know that the previous 3 settlements have already happened, only the last is left in 60 days. Step 1, let's turn those interest rates into discount factors. So we were told after 300 days we had 5.4% as the USD rate. And a 6.5% as the GBP rate. Those rates are always quoted annually. So, let's deannualize those rates and calculate the discount factor, which are 0.99108 for USD and 0.98928 for GBP. The discount factor gives us the present value of future cash flow. So all we need is the actual cash flows. Well, what's the payment going to be in US dollars? Well, there is only one settlement date left at T360 in the initial swap in 60 days' time now for USD. And it's going to be 1,011,000. Where does that come from? Well, we have each payment calculated earlier on. Of $11,000. That's our final quarterly payment. Plus another 1 million. Which is the notional principal being swapped. So on that final date, there's the $11,000 and the notional principal of $1 million. So that's the final payment. To get that back to present value, let's use the 60-day discount factor. We calculated as 0.99108. That gives us the present value of those US dollars. Then the same thing that you repeat with GBP. Well, we have the last GBP payment of 8480 and the notional principal of 0.5 million. We need to multiply it by the 60-day discount factor to come up with a present value of the GBP side. Now at this stage, don't lose focus, you're so close within touching distance. We've just got the final payments, brought them back to PV. Don't be tempted to net these two off. It's highly possible one of the distractor answers is if you just try and get those two off, you can't. They are different currencies. So your final step is to bring them both back into a common currency. So which currency? The examiner will give you guidance. So here we're going to take it back into US dollars. We just worked out the value of the GBP side, which is 503,031 GBP. Turn that back into USD. We are going from the price GBP to the base USD and we were told the exchange rate was 0.55. Price to base. We are dividing by the exchange rate to get 914,601 US dollars. Now we have the value of the USD side and we have the value of the GBP side in US dollars. Final step. We can now net them off. So the value to the received dollar side, well, the value of the dollars that we are going to receive PV is 1,001,982. Less what we're gonna pay. If we're receiving the US side, we are paying the GBP. So you can knock off the value in US dollars of that GBP side. The net of those two is 87,381. Positive value to the receive US side. It's a long calculation. It's quite involved, but as I always say in swaps, it is mechanical. It's not going to be easy to get done in the time. So if you see a big swap item set like this, it's probably going to be time pressured. So take a view on whether you want to leave that till the end of the exam. But as with everything, if you can practice this to death, get very mechanical about it. It will eventually work well. Next page we are going to talk about equity swap. If you find this explanation helpful, please subscribe.